right, let's go ahead and get started. Happy Friday, everybody. Welcome to our weekly Outlook webinar. My name is Ilian Yotov, founder of allthingsforex.com. I host a popular program Monday through Friday called the All Things Forex broadcast. I just finished the one from earlier this morning. You are welcome to listen either live or just visit my website and see the archive broadcasts available there. Once again, the name of the program is the All Things Forex broadcast, available on allthingsforex.com, also available on fxstreet.com. And speaking about FX Street, I'd like to thank our friends there for putting together the series of these webinars. What we're here to discuss today is the upcoming trading week, October 17th through 21st. However, the trading week is going to expand a little bit further until the 23rd because we have a main event that is coming up scheduled for October the 23rd. And that will be the main spotlight event of the new trading week. What I'm referring to is the European Union Summit, and we will discuss that event in more details. But first, I have chosen the first spotlight event for us next week to kickstart the sequence of important economic data with the U.S. industrial production report. Now, many of you know the industrial production is the main gauge of industrial activity, measures the output of factory mines and the utilities here in the world's largest economy, which is the U.S. economy. And it's going to be important to see whether the U.S. economic data is going to continue the trend that we have seen emerging now since the beginning of October. The trend that I'm referring to emerging since the beginning of October, as I discussed a few weeks ago on this program, in the beginning of October, I said that the market is going to start the quest throughout this month. That we know in October the Fed is not going to meet. They're not meeting until November 1st and 2nd. It's the next 2 days of their next meeting. So the month of October will be a good month for the markets to start this quest to find out, is the U.S. economy really doing as bad as the Fed's gloomy outlook painted it to be? Or are the economic conditions a little bit better? In other words, will the U.S. economy dodge the bullet and avoid the so-called double dip recession? Well, so far, in my opinion, so good. Because in the last few weeks, we have seen a more optimistic non-farm payrolls report. I mean, it's not spectacular, don't get me wrong. But it's a heck of a lot better to see the U.S. economy creating jobs rather than not. Because in the previous month, we've seen dismal non-farm payrolls reports, where in August, we didn't even see a job being created, 0 jobs. So the non-farm payrolls report was more positive. Both of the ISM manufacturing and non-manufacturing sector purchasing managers indexes have stayed above 50, which is the dividing line between economic expansion and contraction. So they held up above 50 into expansion territory. Unlike the European purchasing managers indexes in the Eurozone, both of them dropping below 50, which is the territory of contraction. And then earlier today, we also saw the retail sales from the United States being a little bit better than expected, increasing by 1.1% month over month, compared with a previous flat reading, 0% increase in the month of August. So in September, retail sales made a comeback in a way, increasing by 1.1% month over month. When we take a look at these sequence of events, I think that a trend is emerging, where we're starting to see a little bit more upbeat, better than expected economic reports from the United States. And as long as that continues to be the case, we are going to see a reduction in the odds that the Federal Reserve will be forced into offering another round of quantitative easing, the so-called QE number 3. Although it's still not completely off the table, as the Federal Reserve officials have told us that in the latest testimony of Mr. Bernanke in front of the House Senate Finance Committee, he said that the option is on the table. The minutes earlier this week from the Fed's last meeting also revealed that the Federal Reserve policymakers, some of them were calling for more quantitative easing. But the Fed refrained from doing so, and it decided to go with many of you know, with the so-called Operation Twist, where they're going to sell some of the shorter-term maturity bonds that they're holding on their balance sheets, about $400 billion of that, and then turn around and buy longer-term bonds, anywhere between, with maturities anywhere between 6 and 30 years. So that's so-called Operation Twist. It's designed to, the Fed's doing that so that they can keep rates low across the board. So as long as the economic activity improves, and we see the signs of that throughout the month of October, we could potentially see lesser odds for quantitative easing number 3 by the Federal Reserve, unlike what the Bank of England decided to do, which was, if you recall last week, they announced that they're going to expand their asset purchase program by another 75 billion pounds, which means more quantitative easing that the Bank of England is undertaking. So we'll continue to monitor the data from the United States and from around the world as well throughout next week in order to gauge the state of the worldwide economy, especially the largest economy here in the which is the U.S. economy. So the industrial production consensus forecast for the U.S. industrial production is to see another month of increase, 0.2% month-over-month increase. I mean, it's not impressive, it's not spectacular, it's not huge, but at least it's up by 0.2%. Same reading as the previous month, by the way. As long as we're not declining in a new normal, if this is the new normal, as long as we're not dropping, then it's a little bit more optimistic. As we have seen, by the way, return of optimism and investors, improvement in investor sentiment throughout this, which is helping a lot of major currencies to recover at least some of their losses in the last month and a half versus the US dollar. What I'm referring to, and I will show you with the charts in a few minutes. The euro is recovering its losses, some of its losses, the pound, the Australian dollar, and other currency majors. Now, the next important spotlight event for us next week is going to come from from China, which is the second largest economy in the world to the U.S. economy, but it is the fastest growing economy in the world. Now, China grew by 9.5% in the previous quarter. Now we're expecting a reading of 9.3%. So it may not be that strong, a little bit of a slowdown, but it's not a dramatic slowdown. And as long as that continues to be the case, that could keep investors optimistic that global economy is doing well, which China is very important for global economic growth. So 9.3% quarter over year is the consensus forecast. The Chinese gross domestic product report is going to have potentially an impact not only on the financial markets worldwide, but also on a particular currency, which would be the Australian dollar. Because of the closer relationship between the Chinese economy and the Australian economy, China is the largest trading partner of Australia. So it's crucial for the Australian economy demand to stay strong from China, as we talk about this on a regular basis. So that would be the implication also of the Chinese gross domestic product report on Monday morning. More than likely, a little bit of a pullback there on a quarter-over-year basis. Now, I wanted to show you the third spotlight event for next week, which is going to start a sequence of 3 days of important economic data from the United Kingdom, which is going to keep the British pound in the spotlight, in my opinion, next week, at least on Tuesday, Wednesday, and Thursday. The 3 days of important economic events from the UK are going to start with the Consumer Price Index, which is the main gauge of inflation preferred by the Bank of England. Inflationary pressures, it's no news to anybody, have been very stubbornly high in the United Kingdom, staying above 4% for a number of months, staying above the 3% ceiling. Generally speaking, the Bank of England does not like to see inflationary pressures above the 3% level. Unfortunately for them, however, they have been staying there throughout this year. And despite of the rising inflationary pressures, the Bank of England still has decided to expand the asset purchase program and do further quantitative easing. which a reminder of that decision and the reasons behind it, we're going to see with the following spotlight event on Wednesday from the UK, the Bank of England's meeting minutes. But before we get to the meeting minutes, the Consumer Price Index consensus forecasts are expecting the Consumer Price Index in the United Kingdom to increase by 4.9% year over year, which means that there's going to be a spike expected in inflationary pressures in the UK from 4.5% year over year previously, in a previous month, to now 4.9%. Now, this is going to be also following the harmonized index of consumer prices that we saw earlier this morning in the Eurozone, confirming that there was also a spike, the largest since October of 2008, if I'm not mistaken, in inflationary pressures in the Eurozone. After being flat for a couple of months during the summer at 2.5% year over year, the Eurozone harmonized index of inflation also rose to 3%. So there was that 0.5% spike in inflation. And we can see identical development in the UK with the consumer price index there expected to rise by 0.4%, from 4.5% year over year to 4.9%. This could keep the British pound supported, I think, because rising inflation pressures reduce the odds for further monetary policy loosening, if you will, by the Bank of England. Although the Bank of England has decided, despite of the rising inflation pressures, to proceed with further quantitative easing. Now, let's go ahead and take a quick look at the latest trend developments with the pound against the US dollar. We'll take a look at the daily chart of the pound-dollar currency pair. As you may recall, as we've discussed also in the last several weeks on this program, we have seen the pound developing a strong bearish sequence, a strong decline, which ultimately caused the pound to break below the bottom of its existing range. The pound-dollar exchange rate has been stuck in a range between roughly $1.59 and an important level in my quarters theory, which is the large 4 points of $1.67.50, $1.67.45, which was the high for 2011, only 5 pips below $1.67.50. And you can see that range. I've been showing you that range for months on these webinars, with one exception in July where the pound-dollar pair broke below the bottom of that range for only one day, and it reached a low at $1.57.79, only to see in the days after that the pound to climb back above $1.59 and back into its previous range. But most recently, the pound began falling again from as high as $1.6617 on August the 19th. And then it challenged that bottom of the range around the $1.59. It broke below the support from July at the $1.5779, and it expanded its losses. And I spoke in the last month or so on this program and brought your attention to a phenomenon that I explain in my book, The Quarters Theory, which is what I call a 1,000 pip range transition of the pound-dollar's exchange rate. In other words, the pound transitioned its exchange rate versus the US dollar from the 1,000 pip range between $1.60 and $1.70, or the $1.60s, into the new 1,000 pip range below, which is the $1.50s, between $1.50 and $1.60. Now, these are the major whole numbers and the major large quarter points that I explain in my quarters theory define the 1,000 pip ranges when we speak in terms of price interest points or pips. Between each two whole numbers, major whole numbers, such as $1.50 and $1.60, for example, there is a clearly defined range, which is exactly 10 cents, or in terms of pips, 1,000 pips. So I divide these 1,000 pip ranges with my quarters theory into 4 equal parts. And that is how I derive the 4 large quarters of 250 pips of each 1,000 pip range. And I propose, for those of you who are new to my quarters theory methodologies, I propose that currency exchange rates fluctuations and price fluctuation in general are not chaotic, that they're not random, but rather occur in an organized manner as prices fluctuate between the large quarter points within these large quarters of 250 pips in an organized effort to complete the large quarters, the moves from one large quarter point from another large quarter point, and also in a systematic effort to complete the entire 1,000 pip ranges ultimately. And so the 1,000 pip range transitions are an important development because we can find out whether or not the market is making that major shift, that the current exchange rate, for example, between the pound and the dollar, no longer justify pound-dollar exchange rate above $1.60 into the 1,000 pip range of the $1.60. And so the market quickly began to reprice the current underlying fundamental backdrop for both of these currencies. And so we saw and we noted and we monitored on a weekly basis on this webinar the 1,000 pip range transition of the pound-dollar exchange rate from the $1.60s into the $1.50s, which was, as I noted in previous weeks, a successful transition. The pound, as a matter of fact, made further advancements as expected as a result of successful 1,000 pip range transition. And I'm not going to have time to repeat all of these factors that we discussed and the elements that we monitor and the requirements that I have established with the quarters theory methodology to help us recognize a decisive, successful 1,000 pip range transition. You can certainly go back and listen to previous webinar archives in order to follow up with that if you missed the previous webinars. But I brought your attention that there was a 1,000 pip range transition that was happening, that if successful, the pound could continue making further advancements into that new 1,000 pip range, lower into the $1.50s, and ultimately the pound has reached as low as $1.5271, which is the October 6th low. This low, however, has occurred, and unfortunately we didn't have the broadcast or the webinar last Friday because we had, I believe, the non-farm payrolls, a longer webinar there on Friday morning. So what I was going to talk about last Friday was the fact that, yes, the bearish trend in the last month and a half, almost 2 months, for the pound versus the US dollar is strong. But it was becoming a bit extended as far as trend wave signals. And I count, and that's another thing that I explain in my book, The Quarters Theory. For the lack of a better name, I call it the Quarters Theory Trend Waves methodology, which is based obviously on the classic Elliott wave theory. But when we count the number of waves in a trend progression, I counted 5 consecutive bearish waves on the pound-dollar daily chart. And that's an extended bearish trend wave sequence, which is always a warning sign when we see that overextended sequence of trend waves or extended actual trend waves. There's always a strong probability that a more significant price correction may be coming, that may be overdue. And the pound was one of those currency pairs that was long due for a more significant price correction of these losses that it registered versus the dollar, which were about 1,300 pips. As I said, it dropped from that high at the $1.6617 to the lows at the $1.5271. And so after a month and a half of significant declines, the pound finally, throughout this week, has taken advantage of the return of risk appetite and improvement in investor sentiment, and it's actually producing that overdue price correction. But what is important to note also is that although the pound has managed to bounce off of these lows and correct some of these losses, almost 1,300 pips, or a little bit over 1,300 pips actually, that were lost. Despite of that, this is still a price correction. It's just a more significant price correction and not necessarily a reversal of that negative trend. Now, the bearish breakouts that have occurred recently here below these important support levels that have been holding up for a number of months should not be disregarded, especially during this price correction if the pound-dollar exchange rate fails to break above these resistance levels, because obviously during this price correction, the previous highs that were established here, what was it, $1.5665 or so, or $1.5715, obviously that was a resistance level to watch to see whether that large price correction is going to begin, which it has. The pound broke above that resistance level. We're seeing the price correction. But do not disregard the importance of these other resistance levels that are ahead of us. Obviously, the low of July was an important resistance level, but it is being broken as we speak in a trading session today. $1.5779 was that July support. And on the way up, it established itself as a level of resistance. The pound was testing it 3 days ago, yesterday, and today, finally, it broke above it. Well, some will say, Ilian, this level was broken 3 days ago because the pound reached as high as $1.5797. To me, that is not necessarily a decisive breakout. You see, I have this rule that I also explain in my book, The Quarters Theory, which I call the overshoot rule. In a $4 trillion market volume per day, which the global foreign exchange market has, it's not unusual for us to see some inertia, if you will, of prices. In other words, prices could surpass an important support or resistance level by a few pips. But some traders that would consider that as a breakout often get really disappointed because they find out that prices reverse. It looks like a breakout. It smells like a breakout. It is a higher high or lower low, below support or above resistance. But what happens is a sharp move in the opposite direction, or a head fake in a lot of instances. And that is why I've created the so-called overshoot rule. And I require more significant price moves, larger than 25 pips. You see, with the quarters theory, I work in quarters, in terms of quarters, large and small. A large quarter is a quarter of 250 pips, but when you divide a 100 pip range between two whole numbers, like $1.50 and $1.51, $1.60, or $1.57 and $1.58, you divide these 100 pip ranges into 4 equal parts. I derive the small quarters of 25 pips, and that's one of the practical applications of the small quarters. That I designate an area, one small quarter, 25 pips above an important support or resistance level or large quarter point in my quarters theory, in order to gauge price behavior and recognize signs of strength or weakness. Because an overshoot, generally speaking, which is price move that's less than 25 pips, I would consider not to be a decisive breakout. It's an attempt for a breakout, but it's only an overshoot. Now, if the move is more decisive and it's exceeding 25 pips above a resistance level or below a support level, then we can talk about a more decisive breakout occurring. And that is the move that we saw today. Unlike the overshoot of 19 pips or 18 pips that we saw 3 days ago. It was a test of the resistance, previous support from July, once again, establishing itself as a level of resistance. It was an overshoot 3 days ago. It was the test. A lot of traders on the following day found out it looked like a breakout. It smelled like a breakout, but the pound actually dropped more than 100 pips after it looked like a breakout was occurring. Well, if you were to apply my overshoot rule of my quarters theory, maybe that would have helped you realize that this was not a decisive breakout. And generally speaking, on a first attempt at an important support or resistance level, we should not realistically anticipate that there's going to be a decisive breakout. On a first attempt, in most instances, what we see is an overshoot or prices could come short of a targeted resistance level, and then we can see a bit of a pullback. Now, that is not to say that if the market continues to make further attempts at that level, that level will sustain. An example that we're witnessing today is that finally we're starting to see that decisive breakout that the pound is producing above $57.79. So where to next? Well, think of it in terms of stair steps. We step on one, and then we can see and look forward to the pound-dollar pair stepping to the next level. What's the next level? The beauty of this is that we now are not trading, when it comes to the pound-dollar exchange rate, into uncharted territory. As a matter of fact, we have some very familiar price ranges and territories and reliable support and resistance levels that were previously established. So it would not be illogical for us to anticipate that after the breakout above $57.15, the pound is going to challenge $57.79. And if the $57.79 is decisively broken, which it is today, then the pound-dollar pair would challenge the next level of important resistance, which would be the $1.59 area. If you recall the $59.11, there was support there. $58.82. These are some areas of resistance there that the pound could challenge next. And then if these levels are broken, then we can even see a move to the major large quarter point, which is also a very important price level at the $1.60. So we're going to, heading into next week, we're going to monitor the next several important resistance levels that are ahead for the pound-dollar pair, and based on whether or not they're broken above successfully, we will gauge the odds for the next move. Now, I have to wave a bit of a red flag here, and I hate to be the buzzkill when it comes to the excitement on this rally throughout this week and throughout the last 6 days for the pound and 8 days for the euro and the Australian dollar. I have to raise the red flag a little bit and sound the warning alarm that we may be due for a price correction as well, following these strong moves for all three of these major currencies. And later on, I'll show you the euro-dollar pair as well, and also the Aussie dollar. And the reason I'm saying that is because the pound has been rallying now for 6 days, and granted, the market could decide to let the British pound run for another 6 days or 60 days for that matter. I'm not going to limit the amount of days that the market decides to continue this price correction for the pound. But 6 days into it, I have to warn that there may be a possibility for at least a bit of a price correction, which means that the pound could pull back from these levels. And what a better area for the pound to establish and encounter resistance and start that pullback than previous important support levels that on the way up could establish themselves as levels of resistance. So really going to be crucial next week whether the pound manages successfully to break above $1.59 area, and it's going to be a bit of a problematic area, to put it this way. There's a cluster of resistance levels. $59.11. You have that previous support here at the $59.37. And then above that, you have the major large quarter point at the $1.60. That's what I'm referring to when I say a cluster of resistances within an area of about 100 pips between $59 and $60. Don't be surprised to see some exhaustion of the pound's bullish momentum within this area, especially ahead of the important event on Wednesday, which is, I think, going to be a reminder for us that of the reasons and the concerns that were the reasons behind the decision by the Bank of England to expand its quantitative easing asset purchase program. That event is going to be the Bank of England meeting minutes on Wednesday morning at 4:30 a.m. Eastern Time, which will give us more details on what went behind the closed doors at the Bank of England's meeting earlier in October. Now, As many of you know, the Bank of England decided to go with another round of quantitative easing, a very significant increase in the size of the expansion of the asset purchase program, £75 billion, considering that it has been kept at £200 billion for the last year and a half, hasn't it? Or so. What was that decision about? Well, experts estimate that instead of the Bank of England going with an actual rate cut, the benchmark rate in the United Kingdom is 0.5%, which is very low, historic low. But instead of the option of Bank of England cutting rates further to stimulate the economy, lower interest rates across the board, and stimulate economic activity, the Bank of England decided to go with £75 billion pounds of quantitative easing, which some experts estimate that is the equivalent to 75 basis points of an interest rate cut. So it's a pretty significant move that the Bank of England decided to make. Some are even saying that that was a vote of no confidence by the Bank of England in the ability of European leaders to contain the debt crisis, which obviously will have a negative impact on the United Kingdom's economy, because the Eurozone is the largest trading partner of the UK. So that was behind the move. And if we get to see more details on that pessimism or vote of no confidence from the Bank of England policymakers, then that could maybe bring back to reality traders who have enjoyed this rally throughout this week, but could put some pressure on the British pound again. Now, before the Bank of England's decision, we're going to see the first one of the two, or rather three, important economic events from the Eurozone. With the German ZEW Economic Sentiment Index. Now, ZEW is an institute in Germany, puts together a survey of economic sentiment and ultimately compiles an index based on it. Consensus forecasts are pointing to a larger decline in the index from minus 43.3 to minus 44.7 for next Tuesday, which would be an indicator of deteriorating sentiment and also a leading indicator of economic conditions in the Eurozone, which are not very rosy, as many of you may have noticed in recent months. So that also could bring back to reality traders after the Euros round in the last 8 consecutive trading sessions. Now, that's also a certain amount of a short squeeze that I feel is taking place. And let me help you visualize that by taking a quick look at the euro-dollar daily chart. Just as the pound has rallied in the last 6 consecutive trading sessions, so has the euro versus the US dollar. Now, the euro's rally is even more significant because the euro is rallying for 8 consecutive trading sessions. But that, as I said with the pound earlier, that is still not the end of that bearish trend, in my opinion. Despite of that significant price correction for the euro, which is rather significant, obviously, the euro has declined about 1,400 pips from as high as $1.4548 on August 29th to recent lows at $1.3145. As I have discussed in the last couple of months, the euro has also transitioned its exchange rate into a new 1,000 pip range, falling from the $1.40s into the $1.30s. And it almost managed to complete the entire 1,000 pip range between $1.40 and $1.30. It stayed 145 pips above the major large quarter point, the $1.30, almost completing the entire 1,000 pips range from $1.40 to $1.30. However, the euro was becoming the losses for the euro were becoming a bit extended. And if I had a chance to have this program, last Friday, I would have brought your attention to that, just as I mentioned earlier with the pound against the dollar, that the euro may be due this week for a price correction. Indeed, the euro did take advantage of the positive news. Well, at least for now, we feel that European leaders finally realized a year and a half later that the situation really is dire. It's critical in the Eurozone. And so there were some new agreements by the German Chancellor and the French President that there will be a recapitalization of banks, and hopefully more details are going to be announced on October 23rd, next Sunday, which would be the main event that I've chosen for next week, the European Union Summit. That's, at least for now, the deadline. And along with that, and the passage of the approval of the FSF changes in Malta earlier this week, and then in Slovakia, despite of the political drama that took place there, we have seen Slovakia now approving the changes to the FSF. It was the final country to approve the changes to the European Financial Stability Facility Fund, which is the temporary bailout fund for the Eurozone. We have seen some more calls from European officials throughout this week for the establishment of the permanent European Stability Mechanism, which is the permanent bailout fund, which is supposed to start being functional in the summer of 2013. Now, there's calls for that fund to be established a year earlier, in the summer of 2012. All of that is positive news. But have we seen the same positive news and promises from European leaders in the last year and a half? Yes. Is it different this time? Let's hope so. No one wants an Armageddon. But I can't help but being pessimistic, because in the last year and a half we have seen promises, and what sounded good on words ended up not looking as good. So if we end up seeing the same thing happening all over again, the euro could very quickly resume that bearish trend that it started a month and a half ago, after this more significant price correction is over with. Now, the euro has lost about 1,400 pips. So I calculated weeks ago that up to 50% retracement would send the euro-dollar pair to about $1.38.5 area. I mean, that's not difficult to calculate. It doesn't take a rocket science. If you have 1,400 pips of a decline, a more significant price correction for the euro up to 50% with natural retracement would bring the euro up by about 700 pips. From $1.37, 31.5 area, that ought to bring the euro up to the $1.38.5 area, or at least the euro could challenge and approach that previous support level from July, which on the way up could establish itself as an important level of resistance. $1.3837 is the level I'm referring to. Indeed, this week, the euro did exactly that. It even is breaking above $1.3837 in the trading session today, and now heading to the next important level of resistance. Just as the pound-dollar exchange rate was confined in a range for a number of months, so was the euro-dollar rate. And the bottom of that range was approximately the $1.40 level, with a bit of an overshoot below it, the low at the $1.3969 that was reached in May. That level served as the bottom of the range until July, when we broke below it, the euro jumped back into it, and then finally, just as the pound broke below that level. I also explained in the last month on these webinars the leader-laggard relationship that was established, and the trader could have benefited from if they were to spot that relationship between the euro-dollar pair serving as a leader of these breakouts and bearish developments to the British pound. The pound-dollar pair was the laggard. It did exactly the same that the euro did, only days and a week or so late, which could have given time for traders who missed the developments with the euro to maybe take advantage of the similar developments with the pound-dollar pair. I'm not going to have time to explain that in detail, but once again, I know that the archives are available. You can always go to fx3.com and catch up on these things. It would be, I think, for those of you who are new, just logging in today for the first time, wondering what is this guy in the world talking about, go back to the archives, check them out. It will be, I think, a good learning experience for a lot of you who have missed these previous webinars. Now, on the way up, just as the pound dollar pair, the euro is producing a larger price correction of these losses. It's breaking above the July support, now resistance, $1.3837, opening the door for the euro-dollar pair to challenge previous resistance, aka support levels, at $1.3936, which was the resistance from September 15th, and shortly above that level is the bottom of the previous range at $1.3969, which could establish itself, of course, as a level of resistance. Just as I said earlier with the pound-dollar pair, the euro-dollar pair could now also encounter what I would call a cluster of resistance levels. $1.3936, $1.3969, and then ultimately the major large quarter point at $1.40. So three of them. And it's all within a range of approximately 100 pips, between $1.39 and $1.40. That would be the area to watch for any signs of exhaustion for the euro versus the US dollar, which could end that overextended bullish reversal trigger wave, as I call them in my quarter steer, in the opposite direction. This is a corrective bullish wave, obviously. It's not necessarily, I call them reversal trigger waves because they could trigger a reversal. The word trigger could trigger is important to note here. They could trigger and could lead to a reversal, but not necessarily at this point, especially if they're followed by consecutive bullish waves, reversal could occur. But at this point, it's just a potential trigger, but more of a, what I would call, corrective wave to that three bearish trend wave sequence that the euro produced. It gives the opportunity for the euro to go through a period of a welcome, more significant price correction, which now that we've broken above the 50% retracement level, the next level of Fibonacci retracement would be about 61.8%. If you do the math, again, it's not very difficult to figure out that the previous resistance areas, a little bit above $1.39, between $1.39 and $1.40, would be approximately 61.8% retrace areas. So with the close proximity of these resistances, $1.3936 and $1.3969, be on the lookout next week. If we get back to reality, if the euro starts experiencing some resistance there and begins to lose that upward momentum, which would mean that price correction could follow that bullish trend wave, where the euro is already moving, almost 750 pips as of today. That's the price correction so far, and the range of this bullish trend. So the ZEW survey, we're expecting to be a little bit more negative, have more negative undertone. And then later on in the week, we're also going to see the IFO survey. That's the number 9 spotlight event on Friday morning from German IFO Business Climate Expectations Index, another leading indicator of economic conditions in the Eurozone. Another report from the Eurozone next Friday that is expected to show a little bit of a decline in business climate sentiment. From 107.5 in the previous month to 106.3 is the consensus forecast. So ZEW and IFO might be having weak undertones from the Eurozone, and that's going to lead us to the European Union Summit, which is the main event from the Eurozone on Sunday, October 23rd. But before we get to that, we're going to see a sequence of important U.S. economic data, starting with the industrial production on Monday, consumer price index, and housing starts on Wednesday. Consumer prices are expected to increase by 0.4% month over month, same as the previous month, 0.2% for the core consumer price index, which excludes volatile items like food and energy costs. 0.2% increase month over month in inflation pressure. We're seeing inflationary pressures picking up a little. Main reason for the Eurozone increase in inflation, a rising energy price. More than likely that will be the reason why the consumer price index in the UK is going to increase, and for the US as well. Even more important next week is going to be the sequence of housing market reports from the United States that will give us an idea as to what is the situation with a very important sector of the U.S. economy, because it, just as the jobs market and the labor market sector, the housing is not doing very well either. It's very weak. Now, the housing starts for next week are expected to increase to 590 million from 590,000 from 570,000 in August, 590,000 in September. Again, nothing spectacular. And then on Thursday, we are going to see the U.S. existing home sales, which is an even more important gauge of the state of the U.S. housing market. And the existing home sales could show us weakness, which would not be surprising to see the U.S. Housing market still weak. Existing home sales are expected to show us 4.95 million. So 4,950,000 homes sold, existing homes, which would be a lower reading than the 5.03 million in the previous month. In other words, both the housing starts and existing home sales could continue to confirm the weakness in the U.S. housing market. So that would be a couple of potentially weak economic reports from the United States, unlike the reports that we have seen in the previous couple of weeks, which have been more positive than expected. Now, if we get positive surprises from the housing starts and existing home sales, that could continue to fuel improvement in investor sentiment and rallying equities and so forth. Also on Thursday, another third important event from the UK with the retail sales. They're expected to show signs of improvement as well. UK retail sales are expected to increase by 0.1% month over month after dropping 0.2% in the previous month. And, of course, the main event. None of this important economic data, but nevertheless, none of it will matter, I think, that much, because all eyes are going to be on the European Union Summit. The details. That is the meeting where European Union leaders are expected to reveal the details on the new plans that were proposed for bank recapitalization, other measures to contain the debt crisis, and also details on whether or not there will be increased the size of the European Financial Stability Facility to give it more so-called firepower for more bailouts and ways to arsenal to contain the debt crisis. Will there be haircuts? What will be the size of the losses? So, see, the word losses is a strong word. So, leaders have been talking about haircuts because that doesn't sound as bad as a loss. Just haircuts. How big of a haircut will investors have to take? Private investors of Greek government debt. Will it be 25%, which were the initial numbers that were circling the news wires a couple of months ago? Then they were increased to 50 to 60%. Some of them were even saying maybe even 75%. That's a pretty large haircut, in my opinion, that could really spook some of that investor sentiment that's becoming more positive throughout this week. So the elements of that plan are going to be so crucial for the future fate of the euro that summit is going to be the event to watch next Sunday. European leaders have promised to complete the plan at the October 23rd summit and get it ready to present it to the gathering of G20 chiefs on November 3rd and 4th, which is the G20 meeting in the south of France, in Cannes, that's coming up in the early days of November. So what we're talking about here is, please save the dates, because these are important dates, and I'm talking about a couple of weeks that will be on the horizon that would be crucial for, will reveal either the next step of the Greek debt crisis, the next act of the Greek drama, and we'll see whether it is a positive or a more negative one. On top of that, Greece has to receive their next funding, which the troika of auditors by the International Monetary Fund, the European Union, and the European Central Bank said that they recommended earlier this week that Greece receives that money because they're going to run out of cash in early November. We have a question. Do you really expect hard details from the Euro Summit? It did not happen for a year now. It didn't happen for a year and a half now, if I might add. So our listener says, it's just ideas and Europe is very divided. There is no consensus. It says, I'm European. I do not have a lot of confidence in it. What will be the effect of no details, no real plan? Well, it will be devastating. As I was saying in the beginning of the program, the European leaders have shown us in the last year and a half that they're good at a couple of things. Promises and buying time. And that's what we've seen in the last couple of weeks, in my opinion. Promises, promising words, and it sounds good on words. But when we find out, patiently wait, of course, and we'll get to the next promised date when they promise this is going to be it, that's going to be when we reveal these plans, and it's going to be amazing. It turns out that the plan is not really looking as good as it sounded. And that's obviously a problem. And that's why, despite of this euphoria that we're seeing throughout this week, I can't help but being more pessimistic. It's just what I feel, based on what's been going on in the last year and a half. Thank you. Great question. That I think that if there are no concrete details, it's just an empty talk again, and there is no consensus, we'll get that division, we'll continue to see that division. Well, maybe European leaders, that's the hope, that's the rally this week. That, well, okay, they didn't realize it for a year and a half, but now they're starting to realize it. Hopefully that is the case. Like I said earlier, no one wants an Armageddon. But if it sounds too good and then we find out that in reality it doesn't look as good as it may have sounded, that could weigh on the euro. And the euro could very quickly resume that negative trend that it has established in the last year and a half. Not year and a half, but rather month and a half after that more significant price correction is over with. Very quickly, for a few minutes, I want to answer the question from one of our listeners who said, could you please look at the Aussie dollar pair as well, please? Seems to have bounced quite a bit. Yes, as I mentioned earlier, the only of next week that's going to be important for the Australian dollar economic event would be the Chinese gross domestic product report, I think. And because of the close relationship between China and, okay, hold on one second, something's happened. Okay, here we go. So let's take a look at the Aussie US dollar currency pair. We'll take a look at the daily chart. Just as the euro, the Australian dollar is also rallying for 8 consecutive trading sessions. And I said that the euro price correction is about a little bit over 50% now. The Australian dollar's price correction is beginning to get a bit larger, especially after the bullish move today. And we're seeing the Aussie bouncing off of the lows at below 0.94 cents, now to reach intraday highs today at the $1.0326. In other words, the Australian dollar is now the currency pair compared with the euro dollar and the pound dollar, which is still within their current 1,000 range where they recently transitioned. The Aussie dollar pair is the pair that's making an attempt to transition its exchange rate back into its previous 1,000 pip range, where the Aussie dollar pair exchange rate has been stuck within for a number of months. And that's the range between $1 and $1.10. So the Aussie is climbing into that previous 1,000 pip range. Now those are previous support levels there that I have had from previous days. Here's the $1 parity level. Here's the next major large quarter point at $1.10. That's your 1,000 pip range that the Aussie dollar exchange rate, after moving below it, transitioning into the new 1,000 pip range between 0.90 and $1, now it's making an attempt to move back into the previous 1,000 pip range between $1 and $1.10. And it is a very strong move, but again, I hate to be the buzzkill, but the Australian dollar has been rallying for 8 consecutive trading sessions. It's already gained almost 1,000 pips. It reached $1.0326 from as low as 0.9387. If it goes up another 60 pips from where it is with the intraday high today, that will be 1,000 pips of a move high. It's a very significant price correction, but it's still not a reversal. The Aussie 100% retracement level for the Aussie would be that high at the $1.0764. So as long as it stays below that level, there will be potential for the Australian dollar to resume that bearish trend in the last month and a half versus the dollar after the price correction is over with. But there are some warning signs that this, and there will be even more warning signs if the Aussie breaks above $1.04, $1.05 large quarter point. That correction might exceed the normal retracement levels, which I think up to 61.8% retracement is normal. And with the levels that we're reaching now, we're really pushing. We're maybe starting to see some warning signs. But do not be surprised. Despite of the rally of the Australian dollar, I think that's due for a price correction. It's kind of euphoric, this buying, especially into the trading session today. It's becoming a bit too much of a euphoria to me. And if we get to see a back to reality type of moves next week, that would be the type of moves that we'll see a pullback for all of these majors, the euro, the pound, the US dollar, especially if some resistance is encountered at previous levels. The closest level of resistance here for the Aussie would be a little bit below $1.04. That's the previous resistance at $1.0397 from September 16th. So we'll watch that level. If the Aussie begins to find some exhaustion there, that level was, by the way, a previous level of support here as well at the $1.0391, a bottom of a range that was established. Let me move this line here so you can better visualize. If you can imagine this range and that support level, move to the top of the range, get back to the bottom, broke below it, broke again below it, now on the way up, that level could be challenged as a level of resistance. It's very similar type of trend developments as with the other two currency pairs we discussed earlier, the euro dollar and the pound dollar pair. These resistance levels, previous support level, new resistance levels on the way up, should be closely monitored for signs of exhaustion. And when if we're able to spot some of these exhaustions, then we can see more significant price corrections coming in. for these overextended 8 days old bullish waves for the Australian dollar versus the US dollar and the euro versus the dollar. The Aus could, on that price correction, could at least move lower to the parity level once again. And that would be a scenario that I think could play out in the days ahead of us. We'll follow up, of course, on all of these scenarios next Friday at 10 a.m. Eastern Time, which is our usual time. And now you are prepared for all of the important economic reports for next week. I'd like to invite you to listen to my daily program, the All Things Forex broadcast, Monday through Friday on allthingsforex.com. Thank you to our friends at fxstreet.com. Thank you guys for the great questions and your participation in the program today. Have a great day and a great weekend, and I look forward to seeing you again next Friday at 10 a.m. Eastern Time.